Okay, hey everybody. So I thought it'd be easiest to maybe just articulate this with a little visual, a little whiteboard. So we'll keep this short and brief, but I know that this topic is a polarizing one. I know this one is agitating. This is to lay out the agnostic nature of compensation and to try and make everyone aware in the Wealth Matters audience and beyond what the universal law of compensation actually is made up of, what contributes to it, and why we see these disparities, and how you can leverage it, how you can understand it at a level where you could maybe protect yourself, regardless of what your income goals may be, and also how you can level set and stay out of the hype and rhetoric when things like what happened yesterday happen and are used to inflame different sides of each equation, or maybe, quite frankly, just that aren't fair, right? Because a lot of times things just aren't fair. So I'm going to use a simple example that hopefully will be less agitating, but contextualize this for you because there are universal laws that are part of living human experience. That, for instance, gravity, right? We're all familiar with gravity. So if I talk about gravity with you, most of us don't really know the speed at which something falls to the earth on the top of our head, meaning we're not Isaac Newton. We don't necessarily know the science behind gravity, but almost all of us are aware of the reality of gravity and the fact that I'm sitting down right now and not floating around in the air because there's this universal law that is part of our atmosphere that is called gravity, and that below a certain level in that atmosphere, it is engaged and it keeps us all kind of stuck to this big rock. And the reason why I bring up gravity is because a lot of times when we talk about compensation, for instance, Adam Newman yesterday at WeWork getting $1.7 billion buyout to basically walk away from a company that has failed and lost over 84% of its market capitalization in the last couple months. And Softbank comes in and basically, structures a deal yesterday that gets announced that's a total compensation package of 1.7 billion. Meanwhile, somewhere in the neighborhood of 5 to 10,000 employees were laid off from WeWork right after they canceled their IPO, which most of those people thought they were going to be low-level millionaires and kind of living the dream for their hard efforts, and unfortunately kind of got the other side of the law of compensation. So I think that it's very important that I kind of lay this out, both from a sense of how gravity works so that we can contextualize compensation works the same way, meaning it's agnostic. And then we'll talk about what actually the inputs are to the law of compensation and why Adam really got paid what he got paid. And whether we agree with it or not, or whether we think it's right or not, why it occurs. Because that'll help maybe normalize how you can approach both your current opportunity. It'll help maybe you normalize the investments that you're making and understanding where they're at risk or where they're on the right side of being benefiting from a bubble, and also just what kind of the masses deal with and how to even properly compensate employees from time to time. So anyway, regardless of the side you're looking at this from, I thought this might be informative and educational, and I hope you understand my intent is not to deepen or polarize this further, but to kind of level set it and allow us to think about it agnostically for what it is. So gravity. Gravity doesn't care if you're Mother Teresa, that's the angel, or Adolf Hitler, that's the devil. If you violate the law of gravity and you step off this building, you're going down splat on the ground, regardless of whether you're a good person or a bad person. That's the reality. Gravity treats us all equally. Compensation treats us all equally. The law of compensation doesn't care if you're an idiot, a jerk, a good person, a great person. The three inputs to the law of compensation make sure that it works the way that it works, just like gravity, regardless of who you are coming into it. This is why when we get irritated about people we don't think deserve compensation, we can understand it not from a level of did they deserve it or not. Maybe they didn't deserve it. Maybe the system's designs are flawed. Okay, something to look at. But it's not that they didn't deserve it or that they did. Good people don't deserve to die any faster or worse as gravity's concerned as bad people. It just treats everything the same, whether it's a rock or a human. And compensation, the law of it is the same. So let's talk about the law. The law of compensation, I'm going to put dollar signs there. You can put BTC or euros or whatever your favorite form of compensation is, but just to keep the shorthand there. So the law works like this. There are three inputs. The first input, and I'm going to contextualize this around WeWork, is the need. So let's talk about the need. The need is made up of several things. The need in the marketplace for what we do. How big is it? How small is it? Right? We can all have heard this in business. We've said, well, let's find a need, addressable market. Let's figure out how big that total need is. Let's figure out how we get to one user and then how one user scales to multiple. So the need for what we do is a key input into how much we will or will not earn. Because if the need is big and we fill a small portion of it, we do that, then we have a chance to make some pretty good money. If the need is small, but we dominate that market, we have a chance to take all the rewards in that small needed marketplace. In WeWork's case, there was a need. There was several prongs to this need. First prong was real estate owners. Okay, so people that own real estate, big buildings, high rises in towns all over, from New York to wherever. These people had a business model that required long-term leases, 10-year leases, 5 years, triple nets, all these things, right? And in a world that is becoming increasingly more mobile and increasingly more distributed as far as the workforce goes, businesses were less and less likely to continue to want to tie up resources as well as liability for long-term contracts. Well, if I'm a building owner and I've owned this big building that's several 100,000 square feet or tens of thousands of square feet, it's very costly from a capital expenditure standpoint for me to improve it, to try and ride some kind of trend. And I'm not certain that if I do that, that my business model will still attract the right amount of people that are stable tenants. And so the need was, I need to continue to increase rents and capture rents and decrease vacancy. And I need my building to stay populated because that's my source of income and that's my source of value creation. But the market is shifting on me. The need for end users, so call it tenants, was something related more to the gig economy. I need a desk. I need a space to rent for an hour. I need a space to rent month to month. I need a suite to rent month to month because I'm not sure how many employees I'm going to have or how many 1099s I'm going to have 3 months from now, because if my business takes off, I might need more space. But if it doesn't, I might need less space. And so I need flexibility in my lease, and I need something affordable. So I'm happy to pay a slight premium on a per square foot rent, but I don't want to be tied up for 1 year, 3 year, 5 year, 10-year contracts because I honestly don't know whether I'm going to get my next round of funding, whether I'm going to scale or not. And I want to be in a cool place, right? I want to be in a good location. I want to be in the city. I want to be wherever I want to be. So the need was there. The third need was venture capital institutional investors. What do they need? Well, there's a thing called the power law. Most of you are aware of it if you've invested at all, but power law looks like this. There's been stats that show roughly 60% of all a venture fund's returns, meaning a successful venture fund, 60% of all a successful venture fund's returns come from 6% of the companies they invest in. Another way to think about that, simple math, I tell this to entrepreneurs all the time, is if you are going to go pitch a venture capitalist for equity investment, find out the total size of the fund and how many years they've been deploying capital in that fund. That's all you need to know. If they're a $100 million fund and they've been deploying less than 5 years, that means they're still writing checks. That's key, because if they're older than 5 years, they're probably not writing checks anymore. They're only doubling down on their winners that are left. So if they're 1 to 3 years old and they're a $100 million fund, then here's their simple math. They know that no matter how many investments they make, whether they make 50 or whether they make 100 investments, typically it's going to be somewhere in that range, that 1 to 2 of those companies are going to do what's called return the fund. What that means is that 1 to 2 of those companies that they invest in, after they do diligence on all the rest that they could look at, they look at thousands of deals, they pick 50 or they pick 100, they do a term sheet, they get those terms accepted, they wire the money. 1 to 2 of those companies are going to make that fund successful, meaning that they have to bet on 50 companies getting to a big enough exit value, either through acquisition or IPO, to return them on a diluted basis after the preferred stock kicks in, their principal, at least $100 million apiece. So every one of those 50 companies that they wrote a check into, in their mind, fully diluted at exit, is going to write them a check for 100. They also know that 98 of them are never going to get there, right? Some percentage, 15 to 20% of them, are going to basically break even, meaning they're going to return enough money to get their principal back, but they're not going to do any better. The other ones are going to flat out fail and be as if they burned the money. So they need those 1 or 2 to go hockey stick. That's the power law, to return enough money where they can have a 20 to 30% IRR and they can have enough traction in the first 3 years, meaning hype around those good investments in the first 3 years to raise a second fund before those results come in, because that's how they stay employed. Management fees. If they can't raise a second fund, they don't get to stay employed as a venture capitalist for much longer. If they can, they'll stack a second and a third fund off the success and the trajectory of their first fund, according to this, and then they'll be in business for the next 30 years because they'll basically lock up that capital for 10 years with an exit value, and they'll have management fees as part of that contract. And so that's how venture capital works. It's not wrong or right, just how it works. Brass tacks. So if you're going to pitch somebody something, the need is they need to understand how you're going to be one of two out of the 50 that are going to have a chance at returning them whatever the total amount of their fund is. Knowing that 98% of you are not going to do that, they still have to bet on you as if you could be one of them. So these are the three needs in the market that WeWork was facing. Maybe their founder knew it, maybe they didn't, probably did. Number two, the second law of compensation, the second input to the law of compensation is your ability to fill that need. Now, we started touching on that just a minute ago. Do you demonstrate the ability to be one of the 50 or 100 who has the chance to return me my full fund? If you do, then I'm interested. I'll probably give you a term sheet. Beyond that term sheet, once you start executing, your follow-on rounds, meaning the capital stack that you raise after this, is each one of those stacks, how good is your ability to sell that story, to sell that growth, to sell that culture, that transactional value, even though we're losing money because we're betting on growth? How much fuel, how much charismatic CEOing can you do? Charismatic CEOs really took off after Bill Gates and Steve Jobs demonstrated that it mattered, right? We're probably coming to what I call peak charismatic CEO, which means that'll less and less matter. And we'll get back to a different form of fundamentals that people value, like cash flow and profit and that kind of thing. But we've had a nice 20, 30-year run of what's called the charismatic CEO, the founder phenomenon. So the ability of a founder like Adam Neumann to wear the role, to have the vision, to speak it very clearly, to, engage the audience of both tenants and investors and employees was phenomenal, which is why he was able to stay CEO for as long as he did. But even when he threw the warning flag up a couple years ago and said, I don't think we could ever be worth more than 20 billion, at that point, because he did say that publicly, I'm a little worried that we're overvalued at our current capital stack. But again, remember the need here. The need here is institutional capital needs winners. They need momentum investment. And ultimately what they're going to do is look to dump that on the public market at exit and get their return before it comes down to some level of normalcy. So a later stage VC like a Softbank or like some of the pylons that took it from 20 billion to 40 billion, the reason why they took it to those valuations is because they were writing large checks, hundreds of millions of dollars. And in order for that to be fair to both sides, the valuation of the company had to go up so that on a diluted basis, SoftBank still had, 10, 15%, whatever they had. But when you're writing couple $100 billion check, right? All of a sudden that adds billions of dollars to the post-money value of the company, regardless of whether or not the revenue and the costs are there to support it. So the storytelling between the growth, what that new capital infusion is going to allow that growth to accelerate to, and then the early traction of every time we add a unit, here's how many end users we have, here's how much associated revenue, here's how much economies of scale we gain, blah, blah, blah. That story continues to build. And then as it builds, momentum kicks in and people go, oh my God, it's a unicorn, it's a decacorn, it's worth 47 billion, the founders are worth X. And so as the thing moves on, this is where people get screwy, because this is the piece we always forget. Replaceability, for those who can't read backwards, a 15 or 16 letter word. The three things, just like gravity has different forces that make us all hit the earth, the things that make it different between the 5,000 people that get let off and are no longer going to become millionaires are now on the unemployment line, and Adam Neumann, who also gets fired but walks away with $1.7 billion in cash and stock and loans, right, to go away and to stay on very loosely as an advisor. Why is there such a difference? It's not fair. It's not, well, here's why. How hard or difficult is it to replace me? And what have I put in place for myself or my company, if I'm in an industry wondering if I can keep customers or lose them? How hard or difficult is it to replace me? So here's a couple of examples that don't have to do with WeWork, and then we'll come back to how this played out with WeWork. The examples are, when the ice box was invented, there was a need in the market for someone to deliver ice every day to your house. The ability for someone to be on time, do it reliably, not make that ice melt, and deliver it the way was valued. And so they earned whatever they earned. The minute electricity hit and people started to put electric refrigerators in their house and no longer needed ice to be delivered at scale, the need started to diminish for ice builders. Didn't matter how good I was, it meant that I no longer I was replaced by something that wasn't an ice box. I was replaced by something totally different, a different technology that did the same thing, which was kept my food cold, but it did it better, it did it longer, and it required different inputs. And so the whole job called ice delivery guy got eliminated. Now, the whole business, depending on whether or not the icebox company had invested in technology that helped power the electric refrigerator, their whole business could have gone away. If they had bet into their competitive landscape, meaning they had also invested into the GEs of the world or whoever made the first refrigerators, I can't remember, then even though their core business would have disappeared called icebox delivery, they would have had a replaceability factor that said, I own equity in my next incumbent, like the person who's taking me out. And so although my business goes away and all those jobs go away, my net worth will stay intact or continue to rise because I've now bet on the next thing and I was right. The point is replaceability comes down to how difficult or easy to get me out of there. If I'm an employee with stock options, those stock options have to be dealt with, but they're common stock. And so when you talk about the VCs and all the preferred, if we go from 47 billion to 8 billion, all the VCs equity got wiped out. So there's nothing left for the common stockholders. It becomes worthless. Doesn't mean they don't still own the paper that says I have options for 50,000 shares or 100,000 shares. It means that those options are now worthless. So I could execute them or not. They're not worth anything. And to replace me, I can either execute them or rip them up. Doesn't take a lot to do that. So outside of my severance package, which is whatever legally and by law I have to do to compensate people that I now am going to put out of work, meaning they lose their salary, they lose their benefits, whatever that severance package goes into the recapitalization of this newly shrunken company. And part of the turnaround is, well, how do I deal with the people that no longer I need because the company's not as big, I'm shutting down locations. How do I deal with them within the letter of the law and with whatever my ethics and morals are and whatever I think's right? And I get them to go away. But it's a fraction of what the options would have been worth had that $47 billion company gone public and stayed at a decent stock price that mirrored that valuation for 6 months before the lockup was over. So the bottom line is that commons get crushed. Angels, commons, they always get crushed, right? Because in a situation where the VCs get crushed, there's nothing even left. In a situation where the VCs come out okay, there's usually nothing left. So commons only make it when this goes from 47 to 90 billion before their lockup's out, or 50 billion or something higher, right? The bottom line is they don't know that. And so the need for what they do is to fill space doing the work at WeWork. Their ability to do it may be great. The bottom line is WeWork's ability to earn 2 billion and lose 4 doesn't sustain a business. And without follow-on capital stack and increasing valuations, there's no story to sell. And so what do I have to do? Well, I got to blame somebody, and maybe it's rightful blame, but I've got to roll heads, right? I've got to show that we're turning this around. So now I'm Softbank. I've got a decision. I can write down and tell all my limited partners that we're losing every dime of our multi-billion-dollar investment, which was to the tune, I think, $8 billion. We're losing all $8 billion of the money we put into WeWork. Oh, by the way, Uber is in a similar scenario as far as losses for Softbank. So they've got 2 really bad investments now that have lost them tremendous amounts of money, which essentially ensure this fund is not going to return positive to its limits. So they've got other funds, so they'll stay in business because, again, back to the beginning, right? This fund may fail, people may get fired, but SoftBank's not going away. Meanwhile, they go, well, we can either take that full write-down, but we don't have anything else that's even remotely close. Or what we can do is we can invest a little bit more money, we can turn this thing around, and it's going to take us longer, but we think it still has a case and could be a healthy business because, again, back to the original premise, it did solve a real need in the market. It gave real estate owners a way to have one choke to throat, or one throat to choke. I can have WeWork as my master tenant. They're going to pay me every month. I don't have to worry. I can charge them a 10-year lease. I can lock up whatever I want. My business model doesn't have to change. I go to WeWork. All I have to do is let WeWork do the tenant improvements the way they want. So now I'm getting CapEx in my building too, which makes my asset more valuable because WeWork's building it out and giving me the improvements I don't want to spend. And they're giving me monthly rent at the level and the way that I want to receive it. Solve a need, that need still exists. So that's still there. The need for people to have flexible office space, still there. Just not at the scale that the capital stack need was driving it. So Softbank decides, you know what, we're going to turn this thing around. But the new valuation is $8 billion. So everybody gets crammed down, all the option holders get washed out, all the early stage VCs, everybody gets washed out, basically takes the loss. Softbank goes, we're going to put some money in. Oh, but we got this problem. We got this guy that we have to replace. But in order to replace him, he's got, I don't know how many shares he has because I haven't dug that deep into it. This just got announced yesterday. But whatever he's got a ton of shares because he was founder stock. He was worth several $1 billion on paper up until the last couple of weeks. So he's got founder stock. And that founder stock means in order to get him out, voting stock and all that stuff, I've got to buy that stock. I've got to recapitalize that. So just the value of the stock, even though it's worth 1/6 of what it was worth a couple months ago, it still has value. So in order to buy his stock out to get back his voting rights and to get him out of control, I can fire him as chairman, I can fire him as CEO, but I also have to take his stock out in order for my shareholders and my new investors that are riding behind this turnaround plan to buy in, I got to take them out. Well, that's got a value on it. I don't know exactly what the value is, but I know that the loan value was $500 million. I know they're paying them roughly $185 million. So figure on $1.7 million. The ratcheted down value of Adam's founder stock to be replaced was $1 billion. So they're not paying him $1 billion because they think he did a good job or because they like him or because they want the whole world to hate him or they want him to change his hair and shave his head and move and change his name because he's going to be one of the most hated men on the planet by at least the 10,000 people that also worked with him side by side and didn't get that deal. They didn't do it for that. They did it because in order to replace him legally, he had put things in place through the capital stack and through the founder's shares and everything else, like every good founder does. And he had good enough counsel where he didn't get screwed like most founders do. They have to buy him out. Now, maybe they don't have to spend that much. Maybe they gave him a premium. Maybe there's other things going on. Not for me to discuss. The point is replaceability. The cost of replacing him is bigger than the cost of replacing everybody else, and it's the only reason he's getting $1.7 billion. The other $500 million was a loan, a line of credit that he had. Well, in order to get that taken out, they've got to recapitalize that because he probably said, well, I'm not going to sell you these unless you recapitalize that. Part of their deal, from what I've read so far, is that when he sells this stock, because it's not liquid, they're just giving it to him to sell. When he sells this stock, he has to pay back this loan first. So when he sells $1 billion worth of stock, assuming the valuation stays where it is, he's only going to net $500 million. They say only, but the reality is that's still true. They put a trigger in here that says you got to pay back the $500 million line of credit. So he's wise not to roll that up, or he's wise to pay that off so he doesn't have any liability. The $185 million is supposedly for consulting and whatever. Look, in a company this big that grew this fast and had this kind of story, love him or hate him, there's dead bodies all over this thing. Softbank wasn't running this day to day. They've got to now insert somebody, Marcelo Claure, I don't know if I pronounced that right, apparently I'm just looking at the news, is going to replace him as the executive chairman and basically take over and run the company. Well, he may be an operator, he may know how to turn around companies, and that's probably why he put there, but he hasn't been inside this machine, which had up to, I think, 15,000 some odd employees and a bunch of other stuff. So this check is probably just to make sure that Adam doesn't go away and disappear and leave them with stuff they don't know about. The point is, in order to replace him, love it or not, there was enough inertia in place because of this game being played over here, where the cost to replace him was $1.7 billion more than the cost to fire and replace the 5,000 employees that are no longer needed. Like it or not, that is a systems design issue, and that is no different than somebody jumping off the building or someone taking a parachute down because they're aware of the law of compensation or they're aware of the law of gravity. If you work with the law, you can fly or float. If you work against it, you smash to the ground. If you work with the law of compensation, you end up broke, holding pennies, being pissed at everybody. If you work not, you have everybody pissed at you, but you got a couple $100 million net to deal with after the fact. Like it or not, I'm not here to say one's righter or wronger. I'm here to just make you aware of how the game is played. Hope you enjoyed that.